to introduce Cameron with Intouch Insight.
All right. Do we have this? Is this the one that we're using? It works? It does. All right. So as you read on the sign, Maj Soueidan is supposed to be here from GeoInvesting, and he will be showing up. So the first part is me going through just a little bit about the company, and then Maj is going to show up and ask a few questions. That is if Vegas didn't hurt him too badly last night. I guess we'll all find out in about 10 minutes whether that happened or not. I won't spend a lot of time on this slide. I'll assume that you've all memorized it. If anyone asks me, we'll move on. For those of you who may not know the story in terms of what we are, what we do, we are a company that looks after location-based industries. We help them improve their business results, primarily how they operate in each location and how they provide their customer service. So we provide industries such as QSR, gas and convenience, grocery, retail. There's a few million of those around North America and more in the world. So that's kind of our target market. You got to have a lot of different locations, not one central location. We do that through mystery shopping and site audits, where we visit every individual location, which we do quite a bit of. We also do it through, now we've acquired a new startup company, Ardent, October, and we're just getting into that. We do some merchandising, we do some sampling, we do some store resets, some more deeper work in there for some of those same businesses. Then we also have our software side, where we do customer satisfaction surveys and Qualtrics, Medallia, things the QR codes on your receipts. We have a product that delivers that. And we have forms and checklist automation. And the forms and checklist automation is really to help with the internal operations of the companies. And whether you're buying services, software, or both, it all funnels into a central customer experience management platform, which is how we deliver all of the information, the analytics, et cetera, to our clients. And with that, we also, there's Maj now. Come on up to the front, Maj. We have advanced features, which we also sell independently, and we also allow for external programs. And so what we mean by that is, let's say that you're buying services from me, but you're buying software from someone else. You can bring that data from the software or from the services, for that matter, into my platform. Because we have our own technology, and we're unique in that we offer the services and the software, and we're unique in that we have the technology on the services side. So we have a few things that no one has, which allow us to have people come and bring everything into our platform so they can get all their analytics information from us directly. Right now, we're really focused on thought leadership with a couple of key industries, specifically QSR and convenience. We provide studies, we do research, we do speaking engagements, and we're getting a lot of traction on it. We do a study around the drive-through experience with QSR, which has mainline media support. It winds up on Fox News, CNN. And we also do a award in the convenience space called the CSP, Intouch Insight CSP Customer Experience Award. And we give that out every year to the top operator from a large study we do there. And that's done on a main stage with a presentation of the information, the data. We also provide a number of other published studies, such as today, actually, I believe today, we're dropping one with QSR Magazine around emerging experiences. So all of the new things that are being tested and tried in the QSR space, we're going to be doing a study that's going to come out today on that. We have a number of speeches, as I said, on the main stage that we do. And what's interesting is we do not pay to speak. So we're not paying money to be a speaker, right? We go because the quality of what we provide to the conference and the attendees, we get invited to do it. And in one case this year, I'm actually being paid to speak somewhere for an industry. So we've gone a long way with our thought leadership and credibility. And that's led to this slide here where, we've been around 45 years. We've got 4 software products now, 1 platform ecosystem. We have got, 4 of the top 10 QSR, 19 of the top 50. We've got 6 of the top convenience and 14 of the top 50. We're doing business with the largest brands in North America in these spaces, and we're growing. We've got one of the top global beverage manufacturers, one of the top IT companies. So we're not doing, franchisees with 2 locations. We're doing this for large customers and large companies. When you look at the numbers from a financial history standpoint, just looking at the last 10 years, we were growing very well. We were on a great trajectory. Things were awesome. March of 2020, a thing happened. I don't know if it happened where you live or not, but we had a pandemic where we were, and I just told you the industries that we deal with. Well, those industries were the most impacted in terms of the customer experience from the pandemic and how they had to act and operate. So things changed dramatically, things shut down. And we had to get through the pandemic. And then since the pandemic, we've been recovering, and we are now, in fact, back above where we were pre-pandemic. Last year was the first year I did the revenue I expected to do in 2020 had we not had the pandemic. You know, from a EBITDA standpoint, we have been positive throughout the last 10 years, with the exception of a short period of time where we intentionally spent money to get into the software business because we did not have software before that. Other than that one intentional time where we spent a bunch of money, which I'll show you in the next slide, was through a capital raise, we have always bootstrapped the company from basically we use the profits and revenues we can generate on the services and from our legacy business to bootstrap our growth and our creation of new product lines. Shares, we're pretty stingy with shares. We're less than 26 million outstanding today, despite being public since 2002, which means we're not going to the well all the time. We're not raising money all the time. We've only had 2 step changes, and one's a very small step since we went public. One was in 2017, and that's that one capital raise we've ever done that I talked about, and that was to get us into software for the initial go-to. Second one was in 2021. We had to repay, with the best way to put it, some people who stuck with us, including employees through the pandemic, who did not get paid and who held off on pay and things like that. We use shares to compensate people for getting us through a very difficult period during the pandemic. And so there's a small lift there as a result of that in 2021. Otherwise, you'll see we don't raise money. We're stingy with stock. We're pretty flat on that regard. And then this is a slide that Maj will probably want me to leave up here when he asks me questions, and it's got some just the basic data. This is Canadian dollars, by the way, for those of you that are trading on we are trading on the OTCQX as well, so we do have US dollar prices. The Canadian dollar price is 43 cents. We're trading at 0.4 times our price to sales ratio right now. We have not, we did keep our powder pretty dry starting in March of 2020, April 2020. So we have not done a lot of investor relations activity. We've not done a lot of speaking to the market. We have really hunkered down and focused on the business, making sure it was healthy, making sure it was growing, making sure it would return to growth. And you can see, I think, with last year's results that we have done that. Now it's time to start getting out, maybe talking to people a little bit again and getting back out into the market. But we have done a very good job with getting where we want to be. Insider-wise, the chairman of our company is Eric Butel. Him and myself are the 2 largest shareholders. We have a good amount of insider ownership in terms of we are committed. When you have your breakfast, you've got the chicken and you got the pig. Chicken was involved, the pig was committed. We are very much committed from an insider standpoint, but there's still enough stock floating around out there that you can buy and sell shares, at the right price. And with that, I will walk over with this microphone towards Maj, who's now in charge.
And I am supposed to disclose if I own any stock in these fireside chats, and I do own stock of Intouch. Actually, 2019, I think, when we first started talking. Great time to talk to you. Yeah, so, I guess let's get into a few things here. Thanks for the overview. I want to talk about the industry and the landscape, because that's obviously, I think, important to discuss right now. You've gone through, the COVID, now you're here where you're at today. I think, the way your customers are viewing customer experience is kind of it's up and down now. You just don't know where they're, there's terms with, hey, we want to spend money on customer experience, and then maybe, 3-4 months later, it's a little different. But I think you're getting a little more certain in terms of where that's going now. I think I've been reading some of your filings. But when I was reading, some industry information on it, and there was a survey that went out here recently, and it said, versus 2019, customer care leaders are now more focused on improving CX, that's customer experience, reducing contact volumes, deploying AI assistance, and increasing sales generation on service calls. Of those few things, CX ranked the highest in terms of what were important to them. Customer care leaders are facing a perfect storm of challenges. Call volumes are up, employees are leaving and harder to replace, and digital solutions aren't yet delivering on their full promise. And rising customer expectations and decades-high inflation to the mix, it's easy to understand why customer care leaders are feeling the pressure. So I guess that leads into what you're doing a little bit. I just want to come. What this survey is kind of portraying Are you seeing that type of that type of feeling from the customers you're dealing with right now? Or are they there yet?
Yeah, I think so. It's funny. One of my favorite sayings that was, during the pandemic in 2020, 2021 was, "You can't see a smile through a mask." So when you think about what we do in measuring customer experience, measuring, and because how employees act and how employees interact and how employees feel affects customer experience, and you really couldn't tell. And we were all consumers on the planet at the time, right? We all remember Maslow's hierarchy of needs, where we all went from self-actualization to physical, right? We all said, yeah, we don't care if you're nice to me. We don't care. Are your doors open? And will you sell me the thing that I need to buy, right? Do you have toilet paper? Because if you do, then your customer service is the best I've ever had, and that's all that mattered. And unfortunately, what happened was a lot of employees got into some bad habits too. We kind of went away for a while there. It was really a fight for who can provide the best customer service, who can have the best employees and the best. And all of a sudden, we almost trained, people that it wasn't as important anymore. That smiling and being friendly wasn't as important anymore. And it's taken a lot of people a while to recover from that. And I think, and anybody, who's listening, anybody in this room knows that that's the experience we had as consumers, right? It got very frustrating out there. And because everybody now expects customer service to be back the way it was in 2019. And a lot of companies are doing a good job of getting there. But you're right. I mean, I haven't read that particular article, but in general, people are now saying, hey, we expect service to be back. We expect to be treated like a customer. We expect quality. We expect people to be friendly, to do the right things. And it's not yet happening everywhere. And that's, I think, what's probably driving what you're seeing there. Is it because it's it's not going on the way it needs to be? We've seen a little bit of a turn to where companies are now wanting to measure it a little bit more and a little more frequently, and people that weren't measuring it for a while are starting to measure it again because they understand there's a gap in a lot of places between the consumer expectation and what their people are delivering on a consistent basis because their network. And so, I think that this recovery, the thing that hurt us the most is actually created an opportunity now maybe for a little bit of a lift because there's a gap. It's created a bit of a gap between expectations and delivery. And that's where we measure and where we help.
Great. And I'm wondering too, so a lot of what you do though is, mystery shopping, audits on the ground, sending people to places. But, there's obviously now more of this, online push too, right, for customer experience services. You traditionally, I think you're doing that. But have you made a strong push to make that a big part of your growth, your expectations, to where maybe that becomes more important than the on the ground stuff? Is it even possible?
Yes. No, I'll talk about that in two ways. One way is that you are seeing more technology use, right, in terms of how people are delivering services. So basically alternate channels of disruption and ways people can get things. You can order on a mobile app. You can have Uber can deliver it to you. You've got there's all kinds of options where you don't necessarily have to go into a location. And that's one of the things. You can order on the web and Amazon will bring it to you. Right? There's lots of the ways you can go to interact with commerce in the world now. And we can measure all those things because all those things still have an experience. As long as there's a customer journey and customer expectations to measure, we can measure it, and we do. However, from a pure business model standpoint, and this is good news for us, even if you're ordering on an app and doing in-store pickup, right, or even if you're ordering and having it delivered by Uber, there's an execution component at a store near your house, right? Like you're not ordering your Burger King to be delivered to you, right? And it's coming from, a central warehouse near Washington, D.C. I mean, it is coming from the Burger King closest to your home. You may not talk to them. You may never see them. You may interact with an Uber driver, but that's the operation that's delivering it. And so for us, really, it's still about location-based execution, right? We measure different channels. We measure different customer journeys. We measure different ways in which that customer's expectations are being met or not met, whether it's curbside pickup or whatever it is. But at the end of the day, when you break the nuts and bolts down, it still comes down to location-based execution of operating standards and customer experience. And so it's new ways to measure, it's new things to measure, which is great because we sometimes pick up extra programs, right? So because now instead of just measuring the drive-through or just measuring drive-through and carryout, maybe now you got to measure your mobile app experience.
Okay.
You got to measure what was it like to work with the website. Was it frustrating for people? Were they able to change their order? Was the order accurate? I mean, so there's it actually creates new things to measure, but doesn't change the fundamental of the measurement of what they need to do.
Okay, great. So now, you talk about software, and then that was a big part of what you did here to transform the kind of direction of the company. But then you go and buy this Alta, 360, right? Which is not software. So, but I think before I get into the software component, I mean, maybe talk about this Alta, what it did for you. I mean, maybe more than you already have. If I missed it there when you came in. And I have some questions around that too. There's two parts to all 360 acquisition, right? And maybe you can talk about each piece and what it means for the company.
Yeah, so Alta absolutely was a services acquisition. It's buying the same thing that we do, right, from an Alta 360 standpoint. And some people always say, well, how come you're not buying software companies to expand faster? And the answer is really a practical one. Software companies want revenue multiples of 7 or 10 times revenue. Maybe you can get a good deal at 4 or 5. Right? I'm trading at 0.4. Okay. So even if I had a software deal at 3 times, it's not accretive, right? It's very expensive for our current shareholders, and it's not. So that's whereas services revenue, I can buy at a multiple that's reasonable, and I can buy it in a way that it's accretive to the business, so that it can, again, generate more of that cash flow. And so while we don't buy software directly yet because, the deals typically haven't made sense, by buying the services, we buy 2 things that help software. The first thing we buy is additional cash flow, which then we can funnel back into, because as you can see, as we grow in revenue, we're not growing our profits or our EBITDA, right? And so people think, oh, that means you're inefficient. Because if you go back to business school, that would be an inefficient business model, right? The reality is we're bootstrapping a software growth and some other growth as well. And to do that, you need cash flow. And so we use our cash flow and we use it wisely and we use it to grow. So it provides that. And the second thing it provides is a customer base to whom we can sell the software. I know we get to software later, so we'll talk a little bit about that. But so Alta was great for us because they had some convenience store clients, they had some grocery store clients, they had some pretty good clients in spaces that we already play, and they also had some very good employee base. They had a lot of tenure in some of their teams. They had some good leaders. They had a physical office in Toledo, Ohio, Maumee actually, but it's a subdivision of Toledo, which was it's a good cost base in terms of Ohio, and it's not like trying to do something in downtown Los Angeles from a cost base or Seattle, from a labor standpoint. So it had a lot of good things going for it in terms of the employees and their knowledge. It's a great centralized location in a fairly friendly place to do business. So it was a good acquisition from that standpoint. It picked up that customer base for us. So yeah. Right
now, I think you're saying it's similar to what you do, but it's actually a new brand merchandising is not what you've done before.
Yeah,
right?
So that's the second company, which is when we bought Alta, we also got a company called Ardent Field Services, and Ardent is a startup. Literally, it hadn't done $1 of revenue when we bought it, but it had done a lot of legwork, and we did $2.4 million in Q4 with it. And as I've already disclosed in my MD&A, that will come down a little bit, not up for Q1, because we're reevaluating how to best come at it, because we don't feel like we did everything in maybe the right way when we did our first foray at it. It worked well. We still have the same customers, but we think we can do a better job.
You mean from a margin point of view? Is that what you're talking about?
Yeah. Primarily, I think that we could have done a better job with some things. So we want to hunker down a little bit there and get some of that stuff right before we, you don't want to get hyper growth on anything or get real growth unless you have the model right. And so we had a great test in Q4. We're going to have some solid revenues coming up still.
Now, was that one customer, Cameron? Or was that multiple customers?
That was multiple.
Was it? Okay.
It was multiple customers, so it wasn't just one.
And were these customers that you already had in your network, or new customers that you didn't even?
They were net new.
Okay.
So but they're in our industries.
I see.
So they are now customers that we are, of course, going to also work on with our other product lines as well.
Okay. I think that's really was my next thing is you can right away cross market your other stuff, into what they're doing, but you can also take this brand merchandising now model and to your current customer base too, right?
Yeah, like some of the services that Ardent provides are a little more hands-on and complex, and so it's merchandising, it's product, it's inline resets, it's sampling, it's things that are typically lower margin than what we normally do, but it's also high volume, high velocity, recurring revenues. And so that's what we're just digging into.
Okay. So and as you said, there's an element. The Alta and Ardent, they didn't have any software element to them at all, right? So just
zero software. So and so I know we're going to run out of time in a few minutes. So the software part of it, what's cool is if you look at our software growth, we're not some hyper growth software company, but we did $1.5 million last year in SaaS-based software sales, and we're not raising money, right? We're not out spending millions of dollars in marketing. We are bootstrapping of software, and we're really what we found success is selling it to our clients. And so our strategy is to become, again, thought leaders in those industries, to become ingrained with our current clients, and then that opens the door to sell them software. One of our large QSR clients right now, who I'm not allowed to name, but they're one of the big ones that globally. We're in the process of resecuring another 2-year extension on our deal that's in its second year now, and one of the things that we're talking to them about is using software in the new extension. Mm-hmm. And the last couple we were brought on, we only did services. Now we're talking in the first set of extensions, we're talking about can we also get some software and displace some of their existing vendors, because again, bringing in that centralized platform. So really we're seeing success in software, and that's why the software growth is kind of lumpy. It might be flat, and then all of a sudden there's a step. Mm-hmm. And then it's because we're selling it to current clients that we have, as opposed to having anyone here who's ever invested in software has heard the term burn rate, right? We can't afford a big burn rate, right? We're not going to dilute our shareholders. We're not doing that path. So we're selling to existing clients. So the cross sell is 100% important to us. Okay,
great. And regardless, your guidance is pretty nice for 2024 here, right? Yeah. So
yes, we're expecting some significant growth to happen this year. Yeah. Between the acquisitions and some of the organic activity that we have, we're expecting very good growth.
Now in Q4, which you didn't break out in your year end, you did $9 million in your Q4 revenue, which is well above your kind of recent average in the fives. So that was most of it from the acquisition?
Mostly that was acquisition related, and in particular because we did that bump with the Ardent revenue of almost 2.4.
Right.
And which which is not necessarily as I said, and I've disclosed this, we're expecting to come down a little bit as we reset and figure that business out a little bit.
Right.
But we are expecting to see growth and good growth this year. Yeah, 100%.
Great. And so on the software side, again, and if you look at your penetration into your customer base, like what percentage of your customers are actually using your software right now?
Not nearly enough.
Right.
But honestly, it's like 10%.
Okay.
Like there's lots of room for us to sell more software.
So at some point, do you get more aggressive? Do you hire some more salespeople to go after that business, or is it a situation where they're just not ready for it, or they have their own solutions already, and you got to convince them to change software vendors? They have their own stuff.
Typically to the large guys, what we sell is mission critical, so they typically have one already.
Right.
Like it's not optional software; it's stuff they want to use. So there is a displacement factor. It's not greenfield. So it does take time, and really that's why we've worked on the thought leadership piece. And that's why we've worked on some of the other sales piece that we've worked on. Is we've laid the foundation now to where the largest companies on the planet will actually say, yeah, we trust you to take over this mission critical part, of software delivery for us. And we're there now. And so now it's just a matter of time and getting the traction, getting the turnover. And obviously more salespeople always help, but they cost money too.
I think the challenge of valuation really is that people look at you and they look at the labor intensive piece of it, maybe not as a high multiple, but it is reoccurring revenue for you. These companies have been around forever, and nobody else wants to really do this too.
It's recurring revenue. And in fact, in 2004, the first acquisition Intouch did was from a company, and the reason the owner sold in 2004 was because with the internet and customer surveys and everything, they had determined that the services side was dead, and that they would no longer be needed because you had the internet and you had all this survey software and all this other stuff. So he sold because he was scared it was going away, right? That was 20 years ago, and we're seeing it accelerate right now with the current needs in the market. It's
a sticky business, and I think it should be valued that way eventually. Any last minute questions for anybody before we?
I think the guy's telling us we're out of time at the back. Yeah, 1 minute left signed. Well, that's something we're paying attention to in terms of what our investors, what the market is looking for, to be honest with you. One of the things that we did suggest was that we would go for huge growth and no earnings growth, and the market seemed to go meh, right? So I talked about we're looking at art and whether we hunker down into things differently. Part of that is because we had a model where we could grow like stink, but we were doing it without getting a lot of margin, right? And the market kind of said, we're not rewarding you for that. When we made all that public. So at this point, we are currently evaluating that very question because it's really up to us. We have the cash flows. The question is, do we bring it down to the bottom line, or do we continue to invest and bootstrap in the growth side of it? And I can't obviously give you the answer to that right now if I had it because of disclosure rules, but I can tell you that is one of the biggest topics we're trying to figure out, and it's going to be based on what we think our shareholders in the market is looking for these days from companies like ours. I did not.
All right, thank you. Thanks, Cameron. This was awesome.
Thanks, Maj.
Do it again next year, maybe.
Ever enjoy Vegas?
Yeah. Thank you, everybody.